There is a single sentence, spoken by a man from Omaha, Nebraska, that holds the power to create generational wealth. It is a sentence so simple that it sounds almost like a folksy platitude, yet it is so profound that it acts as a skeleton key, unlocking the most deeply guarded vault of financial success. That sentence, the genetic code of a multi-billion-dollar empire built from scratch, is this: be fearful when others are greedy, and greedy when others are fearful. This is not merely a clever turn of phrase, it is a complete investment strategy. It is a psychological operating system designed to systematically reverse engineer the greatest flaws of human nature and turn them into pure profit. It is Warren Buffett's final promise. For the vast majority of people, the stock market is a battlefield of emotion. The ticker tape is not a stream of data, it is an electrocardiogram of our collective hopes and fears. When it surges, we feel euphoria, the intoxicating rush of effortless gain, the fear of being left behind. When it plummets, we feel a cold, primal panic, the visceral terror of loss, the instinct to flee from danger. Buffett's genius was to recognize that this emotional wave was not noise to be filtered out, it was the signal itself. He understood that the moments of maximum greed, when the crowd is chanting for more, are the moments of maximum risk. And more importantly, the moments of maximum fear, when the world is convinced the sky is falling, are the moments of maximum financial opportunity. This is the great paradox of wealth building. The path to safety and riches is not found by running with the herd, but by calmly and deliberately walking in the opposite direction. To do this requires more than just capital. It requires a form of psychological armor. It demands a deep understanding not just of balance sheets and cash flow statements, but of the wiring inside our own skulls. It requires mastering the art of independent thinking while the entire world is screaming that you are wrong. Today, we are not just going to admire this principle from a distance, we are going to deconstruct it, piece by piece. We will dissect the anatomy of market fear and learn how to harness its power. We will diagnose the mechanics of speculative greed and learn how to inoculate ourselves against its contagion. We will build, step by step, the mental framework that allows you to stand apart from the crowd, not out of arrogance, but out of a profound and profitable clarity. This is your guide to profiting from chaos while others are consumed by it. This is your initiation into the world of contrarian investing, where market psychology becomes your greatest asset and panic becomes your best friend. Our journey begins in the heart of the storm. To truly understand the second half of Buffett's maxim, to be greedy when others are fearful, we must first dissect the nature of fear itself. Market fear is not a subtle emotion. It is a tidal wave of panic, a contagion that spreads through headlines and television screens, convincing rational people to abandon their long-term plans in a desperate scramble for perceived safety. It is the feeling of a pit in your stomach as you watch your life savings seemingly evaporate in a sea of red. For most, this is a signal to sell, to get out, to stop the bleeding at any cost. For Buffett, it is a dinner bell. It is the piercing siren that announces the once-in-a-decade sale, where the world's greatest assets are marked down for clearance. To grasp how he cultivated this mindset, we must travel back to the fall of 2008. The air itself felt charged with anxiety. The global financial system was not just cracking, it was shattering. Lehman Brothers, a 158-year-old institution, had evaporated into bankruptcy on September 15th, sending a shockwave of terror across the globe. The credit markets, the very lifeblood of the economy, were frozen solid. Banks refused to lend to anyone, even to each other, fearing that their counterparty could be the next domino to fall. The Dow Jones Industrial Average was in a free fall, plummeting day after day. This was not a correction, it was a full-blown financial crisis, the worst since the Great Depression. The dominant narrative, amplified by every news channel and pundit, was that capitalism itself was on the brink of collapse. This was the moment of maximum fear. And it was in this exact moment that Warren Buffett began to get greedy. Our foundational anecdote begins on September 23, 2008, just 8 days after the Lehman collapse. The world was watching as another titan, Goldman Sachs, the most prestigious investment bank on Wall Street, was teetering. Its stock had been decimated, and rumors swirled that it was facing a crisis of confidence that could trigger a run on the bank. In this vortex of panic, Buffett made a phone call. He wasn't calling to sell, he was calling to buy. He offered to inject $5 billion of his own capital into Goldman Sachs. But this wasn't a simple stock purchase on the open market. This was a masterclass in profiting from fear. Buffett negotiated a deal that was simply unthinkable in normal times. Berkshire Hathaway would receive $5 billion in preferred stock that paid a staggering 10% annual dividend. That meant Goldman Sachs would pay him $500 million every single year, just for the privilege of holding his cash. But that wasn't all. He also received warrants, giving him the right to buy another $5 billion worth of Goldman's common stock at a fixed price of $115 per share anytime over the next 5 years. At the time, Goldman's stock was trading around $125, but the real value was in the 5-year option. Buffett wasn't just investing. He was placing a powerful long-term bet on the survival of a cornerstone of American finance, at a time when almost no one else had the courage or the capital to do so. The effect was electric. The news of Buffett's investment was a powerful vote of confidence. It was the Oracle of Omaha, signaling to a terrified market that a legendary value investor saw not a dying institution, but a world-class franchise on sale. This single act helped to stabilize the bank and, by extension, parts of the market. But Buffett was just getting started. A few weeks later, as the crisis continued to rage, he did it again. General Electric, a blue-chip behemoth of American industry, was also facing a crisis of confidence in its massive financial arm, GE Capital. Buffett swooped in with a $3 billion investment on similarly sweet terms. Preferred stock paying a 10% dividend, plus warrants to buy common stock at a discount. Then came Bank of America in 2011. Still reeling from its acquisition of the failing Countrywide Financial and Merrill Lynch during the crisis. The market was punishing the bank, convinced it was a financial black hole. Buffett invested another $5 billion, securing an even better deal. Preferred stock paying a 6% dividend, but with warrants to buy 700 million shares of common stock for just over $7 a share. Over the next few years, the stock would more than quadruple. In each case, the pattern was identical. Buffett did not act during the preceding years of greed and excess. He waited. He allowed fear to reach a fever pitch. He watched as others, driven by panic, sold off their ownership in magnificent businesses at absurdly low prices. And then, when the blood was literally in the streets, he deployed his capital with decisive, overwhelming force, not as a speculator, but as a provider of stability, and in return, he extracted terms that would guarantee spectacular returns for his shareholders for years to come. This was not market timing. This was opportunity hunting in the most fertile ground imaginable, the terror of others. To understand why this strategy is so potent, we must look beneath the surface of the market and into the primal wiring of the human brain. The underlying psychological principle at play here is a powerful combination of two cognitive biases, loss aversion and herd mentality. Loss aversion, a concept first identified by psychologists Daniel Kahneman and Amos Tversky, is the observation that for humans, the psychological pain of losing is approximately twice as powerful as the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel good. If you lose a $100 bill from your wallet, you will feel devastated, and the intensity of that devastation will be far greater than the joy of the gain. In financial markets, this bias is a weapon of mass wealth destruction. When an investor sees their portfolio decline by 20 or 30% during a market crash, the pain they feel is not just intellectual. It is a visceral, emotional blow. The brain's fear centers light up, triggering a fight or flight response. The overwhelming instinct is to make the pain stop, and the most immediate way to do that is to sell. This is not a rational, calculated decision about the long-term prospects of the underlying businesses they own. It is a primal urge to staunch the bleeding. This is why people who calmly held their stocks for years, will suddenly liquidate their entire life savings at the very bottom of a crisis. Loss aversion hijacks their rational mind. Now combine this with the second principle, herd mentality, also known as social proof. Humans are social creatures. For millennia, our survival depended on our ability to stick with the tribe. If everyone in your tribe suddenly started running, you didn't stop to ask why, you ran too. The one who paused to analyze the situation was likely the one who got eaten by the saber-toothed tiger. This instinct is still deeply embedded within us. In the context of a financial crisis, the herd is the thundering consensus of negative news. Every headline screams collapse. Every analyst on TV warns of further downside. Your colleagues, your friends, your family, everyone is panicking. They are all running for the exits. The pressure to conform, to follow the herd, is immense. To stand your ground and buy when everyone you know is selling feels not just contrarian, it feels insane. It goes against every fiber of your social being. Buffett's genius is not that he is immune to these feelings, it's that he has developed a system to recognize them for what they are, cognitive errors. He sees the market-wide panic, triggered by loss aversion, not as a reflection of fundamental reality, but as a temporary, fear-induced insanity. He sees the stampeding herd not as a source of wisdom, but as the source of the opportunity. They are running away from the saber-toothed tiger, but in their panic they are dropping their most valuable possessions. Buffett simply walks behind them and calmly picks them up. He understands that a great business does not become a bad business overnight just because the stock market has a panic attack. The market's fear creates a massive, temporary gap between the price of an asset and its true underlying value. While the herd is responding to the emotional pain of falling prices, Buffett is responding to the mathematical gift of a lower price tag on the same quality merchandise. His greed is not a manic gamble, it is the cold, calculated exploitation of a predictable psychological flaw in the collective human mind. So how do we translate this profound psychological insight into a practical, repeatable process? The blueprint for this is Buffett's applied mental model of Mr. Market. He first wrote about this in his 1987 letter to shareholders, and it is perhaps the single most important allegory in the history of investing. He asks you to imagine that you are a part owner in a private business, and your only partner is a man named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your shares or sell you his, at a specific price. The crucial thing to understand is that Mr. Market is a manic depressive. Some days, he is euphoric. He sees nothing but a rosy future for your business and quotes a ridiculously high price for your shares. On other days, he is inconsolably pessimistic. He is convinced the business and the world are going to hell in a handbasket and offers to sell you his shares at an absurdly low price. Here's the key. You are under no obligation to trade with him. You can ignore him completely. His mood swings are not your problem. His purpose is not to guide you, but to serve you. If he shows up screaming in terror and offers you a price for his shares that is far below your own calculation of the business's intrinsic value, you should take advantage of his despair and buy. That's being greedy when he is fearful. If he shows up giddy with irrational exuberance and offers you a price far above your calculation of value, you might consider selling him your shares. That's being fearful when he is greedy, but on all the other days, when his price makes no sense, you simply ignore him and go about your day, confident in your ownership of a good business. This simple story is a powerful mental model for emotional detachment. It reframes the stock market from an all-knowing, powerful entity that dictates your financial fate into a moody, unreliable business partner whose emotional outbursts are opportunities to be exploited. Here is the step-by-step blueprint to apply the Mr. Market model to your own wealth building and executive decision-making. Step 1. Do your homework in times of calm. The time to decide what to buy is not in the middle of a panic. You must pre-calculate the intrinsic value of the businesses you want to own long before a crisis hits. This means studying their financial statements, understanding their competitive advantages, their moat, and determining a fair price you'd be willing to pay for the entire company. This value is your anchor of reality. Step 2. Create a panic watch list. This is a short list of world-class, durable businesses that you would love to own for the next 20 years, if only they were cheaper. These are your dream companies, the Coca-Colas, the Apples, the American Expresses of the world. For each company on this list, you set a buy price. This isn't just a random number, it's a price that offers you what Buffett's mentor, Benjamin Graham, called a margin of safety, a significant discount to your calculated intrinsic value. Step 3. Set your price alerts and prepare your capital. The key to being greedy when others are fearful is having the cash ready to deploy. During bull markets, when everyone else is leveraging up, you should be building a fortress of liquidity. This dry powder is your strategic weapon. You then set automated price alerts for the stocks on your watch list at the prices you determined in Step 2. Step 4. Automate your execution and ignore the noise. When the next market crash inevitably arrives, and it will, your alerts will trigger. This is the critical moment. The news will be terrifying. The pundits will be predicting Armageddon. Your friends will call you crazy. Your job is to ignore all of it. Your homework is already done. Your price has been hit. Your decision was made in a moment of cold logic, not hot emotion. You are not market timing, you are value investing. You execute the buy order as planned. You are not buying a falling stock ticker. You are buying a piece of a wonderful business from your manic-depressive partner, Mr. Market, who is having a very bad day. This systematic approach is the direct antidote to emotional investing. It turns market psychology from a headwind into a tailwind. Now let's explore the opposite approach, the path trodden by the 99%. This is the antithesis of the Buffett model, and it's a cautionary tale of wealth evaporation. Let's construct a portrait of the average investor during the 2008 financial crisis. Let's call him Frank. Frank wasn't a speculator, he was a diligent saver. For 15 years, he had been contributing to his 401k, investing in a mix of S&P 500 index funds and a few well-known tech stocks that had done well in the past. By 2007, he had built a respectable nest egg of $500,000. He felt proud and secure. Then, 2008 began. At first, the dips were minor, and he told himself to stay the course. But as the year progressed, the declines steepened. The collapse of Bear Stearns, and then Lehman, turned the slow bleed into a hemorrhage. Every night, Frank would turn on the TV and see experts with grim faces talking about uncharted territory and systemic collapse. He'd log into his retirement account and see the balance plummeting from $500,000 to $400,000, then $350,000. The loss aversion was kicking in. The $50,000 drop from $500 to $450 felt bad. The drop from $350 to $300 felt catastrophic. The pain was unbearable. His colleagues at work were all talking about it. One sold everything in September. Another moved all his money to cash in October. The herd mentality was closing in. Frank felt a rising tide of panic. What if it goes to zero, he thought. I can't lose everything. He held on through Christmas, hoping for a recovery. But early 2009 brought even more pain. The market hit new lows in February and then again in early March. That was the breaking point. On a cold morning in March 2009, with the Dow Jones below 600, Frank finally capitulated. He called his broker and sold everything. He moved his remaining $250,000 into a money market account. The moment he did it, he felt a wave of relief. The bleeding had stopped. The pain was over. He had protected what was left. What Frank didn't realize was that he had just made the single worst financial decision of his life. He had let the market's fear dictate his actions. He had perfectly timed the bottom by selling at it. He had locked in a 50% loss. And the relief he felt was the siren song of financial ruin. While Warren Buffett was collecting his 10% dividends from Goldman Sachs, Frank was earning less than 1% in a cash account, terrified to get back into the market that had burned him so badly. He watched from the sidelines as the market began the longest bull run in its history, doubling, then tripling, then quadrupling off the lows he had sold. By the time he finally felt safe enough to reinvest a few years later, the market was already far higher than where he had sold. He missed the most explosive part of the recovery, a recovery fueled by the very fear that drove him out. This is the path of the 99%. It is a path paved with good intentions but guided by primal fear, leading directly to the destruction of long-term wealth. The direct financial connection between Buffett's approach and Frank's is not a matter of small degrees. It is a chasm that separates financial freedom from a lifetime of struggle. Let's quantify the impact. Buffett's $5 billion investment in Goldman Sachs, made in the crucible of fear, was redeemed by the bank in 2011, netting Berkshire a cool $600 million profit on the preferred shares alone. The 10% dividend had paid him $1.5 billion over 3 years. But the real prize was the warrants. Buffett exercised them, buying Goldman stock at $115. He would go on to sell most of this position years later at prices well over $200 per share, realizing a further profit of over $2 billion. The total take from that single courageous act of greed was well over $3 billion. His Bank of America investment was even more spectacular. By 2017, the $5 billion investment had generated a profit, including dividends and appreciation on the common stock he acquired through his warrants, of more than $12 billion. This is the tangible, quantifiable result of being a calm provider of capital in a storm of fear. Now consider Frank. His $250,000, sold at the market bottom in March 2009, would have been worth over $500,000 again by 2011 if he had simply done nothing. By 2018, it would have been worth over $1 million. By today, it would be significantly more. The financial cost of his fear-driven decision wasn't just the $250,000 he lost. It was the $1 million future he forfeited. The market crash didn't ruin him. His reaction to the market crash ruined him. This is the core of Buffett's principle. The financial markets are a device for transferring wealth from the impatient to the patient, from the emotional to the logical. During a financial crisis, this transfer happens at an accelerated rate. Fear is the catalyst. Those who succumb to it transfer their ownership of the world's most productive assets to those who have the emotional discipline to embrace it. The difference, measured in dollars, is the difference between a comfortable retirement and the creation of a dynasty. Having explored the lucrative power of being greedy when others are fearful, we must now turn our attention to the other side of the coin, the crucial counterbalance that prevents contrarianism from becoming reckless gambling, being fearful when others are greedy. This is perhaps the more difficult discipline. It requires the strength to stand aside while everyone around you is getting rich. It means saying no to the party, even when the music is loudest and the invitations are pouring in. Greed is a far more seductive emotion than fear. It whispers of easy money, of a new paradigm where the old rules of valuation no longer apply. It creates a feedback loop of rising prices and social validation that can feel, for a time, like an unstoppable force. Bubbles are intoxicating, but for Buffett, widespread euphoria is a blaring alarm bell, a signal not of opportunity, but of profound and impending risk. To understand this principle in action, we must rewind to the late 1990s, to a time of irrational exuberance, the era of the dot-com bubble. The internet was a transformative technology, and it was spawning a new generation of companies that promised to change the world. The stock market, particularly the tech-heavy Nasdaq, was on a tear unlike anything seen before. Companies with no profits, no revenues, and sometimes not even a coherent business plan were going public and seeing their stock prices multiply overnight. It was a gold rush, and everyone, it seemed, was a genius. Our foundational anecdote for this pillar is not a story of a brilliant investment Buffett made, but of the investments he famously refused to make. Throughout 1998 and 1999, as the Nasdaq soared, Warren Buffett and Berkshire Hathaway became objects of public scorn and ridicule. Barron's, a respected financial publication, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article detailed Berkshire's disappointing performance, noting that its stock was lagging the S&P 500 significantly. It portrayed Buffett as a relic, a man whose old-fashioned principles of value investing were hopelessly out of touch in the new digital economy. Tech pundits and day traders openly mocked him as a dinosaur who didn't get it. They were investing in companies based on metrics like price to eyeballs or user growth, while Buffett stubbornly insisted on old metrics like price to earnings ratios and predictable cash flows. He watched as companies like pets.com, which was losing money on every bag of dog food it sold, achieved market capitalizations in the hundreds of millions of dollars. He saw companies with .com in their name double in price simply for existing. The social pressure to join the party was immense. Shareholders were questioning him. The media was lambasting him. Yet Buffett did not budge. He famously quipped, "The key to investing is not assessing how much an industry is going to affect society, or how much it will grow, but rather determining the competitive advantage of any given company, and, above all, the durability of that advantage. The products and services that have wide, sustainable moats around them are the ones that deliver rewards to investors." He admitted he didn't know how to value these new tech companies. He couldn't confidently predict what their earnings would be in 5 or 10 years. They were outside his circle of competence, and because he couldn't value them, he wouldn't buy them, no matter how high their stock prices went. He was fearful. While the world was gripped by greed, he was content to sit on a growing pile of cash, looking foolish in the short term, rather than participate in a mania he didn't understand. Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal, soul-crushing decline. Over the next 2.5 years, it would fall nearly 80%. The high-flying .coms that were supposed to change the world went bankrupt in droves. Pets.com, Webvan, eToys all went to zero, wiping out billions of dollars of investor capital. The geniuses of 1999 were exposed as speculators who had confused a bull market for brains. And Warren Buffett? While the market was imploding, his cash-rich Berkshire Hathaway was a fortress of stability. The capital he had preserved by being fearful during the boom was now ready to be deployed into the fear-ridden landscape of the bust. He began to buy solid, old-economy businesses that had been unfairly punished in the tech crash. His patience was vindicated in the most dramatic fashion possible. The episode was a masterclass in emotional discipline. He chose temporary ridicule over permanent capital loss, demonstrating that the highest form of investment intelligence is often knowing what not to do. The psychological forces that create a speculative bubble are as powerful and predictable as those that create a panic. The two key cognitive biases at work are the overconfidence bias and recency bias. Overconfidence bias is the tendency for people to have excessive faith in their own judgments and abilities. In a roaring bull market, everyone starts to feel like an investment prodigy. When every stock you buy goes up, it's easy to attribute this success to your own skill rather than to a rising tide that is lifting all boats. You start to believe you have a special insight, a golden gut. This leads to taking on more and more risk, believing you can't lose. You might start using leverage or concentrating your bets on the hottest sector, convinced of your own invincibility. This is what happened to countless day traders in 1999. They mistook the bull market's generosity for their own genius. Recency bias is the human tendency to give too much weight to recent events when predicting the future. When stocks have been going up for 5 straight years, our brains start to extrapolate that trend indefinitely. The recent past feels like the most likely version of the future. The very idea of a crash starts to feel abstract and unlikely. People will say, "This time it's different," a phrase that Benjamin Graham called the 4 most expensive words in the English language. In the .com era, the "this time it's different" narrative was that the internet had created a new economy where profits didn't matter. This recency bias blinded investors to the lessons of history, namely, that every bubble, without exception, eventually pops. Buffett's antidote to these biases is a deep-seated humility and a profound respect for financial history. He understands that he is not a genius who can predict the future. This humility prevents the overconfidence bias from taking root. He knows that he has made mistakes and will make them again. Furthermore, his worldview is shaped not just by the last 5 years, but by the last 100 years of market cycles. He has studied the tulip mania of the 1600s, the South Sea bubble of the 1700s, and the Roaring Twenties. He knows that human nature doesn't change, and therefore the patterns of boom and bust, driven by greed and fear, will repeat. This long-term perspective is the perfect inoculation against recency bias. While everyone else is focused on the last quarter's returns, Buffett is focused on the last century's lessons. This allows him to see the signs of a bubble not as a reason to celebrate, but as a reason to be deeply, deeply fearful. How can an ordinary person develop this same discipline? The applied mental model for being fearful when others are greedy is what we can call the inevitability of the mean. This model is based on the statistical principle of reversion to the mean, which states that extreme outcomes, both high and low, tend to be followed by outcomes that are closer to the average. In finance, this means that periods of exceptionally high returns are likely to be followed by periods of lower or even negative returns. A stock trading at 100 times earnings will not do so forever. An industry growing at 50% a year will eventually mature. The party always ends. Your job as an investor is not to predict the exact moment it will end, but to recognize that it is, in fact, a party, and to leave before the lights come on and the police arrive. Here is the blueprint for applying the inevitability of the mean model. Step 1. Identify irrational metrics. When you hear people justifying sky-high valuations with new, non-traditional metrics, a red flag should go up. In the dot-com era, it was price per click or website traffic. In other bubbles, it might be something else. If the conversation shifts away from profits, cash flow, and durable competitive advantages and towards exciting but unprofitable narratives, you are likely in a bubble. The first step is to anchor yourself to the timeless metrics of business value. Step 2. Look for euphoria indicators. Greed leaves social footprints. These are qualitative signs that sentiment has become dangerously optimistic. Are your relatives who have never invested before suddenly asking you for stock tips? Are taxi drivers and barbers telling you what to buy? Are business leaders being celebrated on the covers of mainstream magazines like rock stars? Is the dominant cultural conversation revolving around how easy it is to get rich in the stock market? These are all classic textbook signs that greed has supplanted reason and that the market is likely priced for perfection. Step 3. Stress test your portfolio against a return to historical norms. Take your portfolio and ask a simple, brutal question. What would happen to the value of my holdings if their valuation multiples, like the price-to-earnings ratio, returned to their 20-year historical average? This is not a pessimistic scenario, it is a probable one. If this simple calculation reveals a potential for a 40, 50, or 60% loss, it's a clear sign that you are taking on too much risk, fueled by the market's greed. Your portfolio is brittle. Step 4. Actively trim and rebalance. Being fearful doesn't necessarily mean selling everything and going to cash. It means prudently managing risk. As certain positions grow to become an outsized portion of your portfolio due to massive price appreciation, you should trim them back. Sell a portion of the winner and reallocate the capital to less loved, more reasonably valued assets, or hold it in cash. This is a systematic way of selling into strength and greed, and it forces you to take profits off the table before the inevitable reversion to the mean takes them back. Now let's look at the antithesis, the path of the 99% during the dot-com mania. Let's create another character, Susan. In 1998, Susan was a successful dentist with a healthy income. She had her retirement savings in a diversified portfolio of mutual funds. But she felt like she was missing out. The news was filled with stories of 20-somethings becoming millionaires overnight by trading tech stocks. Her brother-in-law, who worked in IT, had made $100,000 on a company called CMGI. It seemed so easy. The fear of missing out, or FOMO, began to gnaw at her. She opened an E-Trade account. At first, she was cautious, buying a little bit of Intel and Cisco. They went up. Her confidence grew. She started reading online message boards where anonymous posters shared hot tips on undiscovered .com stocks. She bought a company called Quantive because she heard it was the next big thing in online advertising. It tripled in 3 months. She felt like a genius. The overconfidence bias was in full bloom. She sold her boring mutual funds and moved the entire amount into a handful of tech stocks whose business models she didn't truly understand. Her portfolio's value soared. She quit working on Fridays to have more time to watch the market. She was addicted to the thrill, to the feeling of effortless wealth creation. She believed, truly believed, that this was a new era and that the gains would never stop. She ignored the warning signs. She didn't care that these companies had no earnings. That was old economy thinking. She was part of the new wave. When the market started to turn in March 2000, she saw it as a quote, buying opportunity. She even took out a home equity line of credit to buy more of her favorite stocks as they fell. This is a classic symptom of bubble psychology, seeing the first signs of a crack not as a warning, but as a chance to double down. But the stocks kept falling. And falling. Her $100,000 gain in Quantive vanished, then turned into a $50,000 loss. By 2002, her entire retirement portfolio, once vibrant and growing, had been reduced by over 80%. The home equity loan was a crushing weight. The dream of easy money had turned into a nightmare of devastating losses. Susan's story is the story of millions. They were not driven by analysis, but by the social contagion of greed. They bought not on value, but on narrative and momentum. And when the tide went out, they were left exposed, their financial futures wrecked on the rocks of their own euphoria. The direct financial connection of Buffett's fearfulness during the dot-com bubble is best illustrated by what it allowed him to do next. While Susan and millions like her were being wiped out, Berkshire Hathaway's balance sheet was a pristine fortress of capital. In his 1999 shareholder letter, written at the peak of the mania, Buffett noted that he was finding very few opportunities to deploy capital at sensible prices. Berkshire's cash pile had swelled to over $30 billion. This cash was not earning exciting returns, and it was the primary reason he was underperforming the market. But that cash was not just idle money. It was what he called optionality. It was the dry powder that would allow him to go big game hunting when the crisis inevitably hit. And that is exactly what happened. In the years following the crash, from 2001 to 2003, the stock market was a wasteland of fear. But for Buffett, it was a target-rich environment. He was able to invest billions of dollars into high-quality, durable businesses at prices that hadn't been seen in years. He wasn't buying the shattered remnants of the dot-coms. He was buying the solid, cash-generating businesses that had been thrown out with the bathwater. Quantitatively, the difference is stark. An investor who put $10,000 into the NASDAQ 100 index at its peak in March 2000 would have seen their investment fall to less than $2,000 by late 2002. It would not recover to its initial value for 15 long years, until 2015. An investor who had followed Buffett's lead and held cash would have preserved their capital entirely. Better yet, if they had deployed that cash near the bottom in 2002, they would have multiplied their money several times over by the end of the decade. The financial advantage of being fearful during times of greed is not just about avoiding losses, it's about preserving the capital that becomes your most powerful tool when fear takes over the market. It is the defensive half of a championship team. It is what ensures you can survive the bubble so you are in a position to thrive in the subsequent bust. The twin pillars of being greedy in fear and fearful in greed form the strategic core of Buffett's philosophy, but they cannot stand on their own. They are supported by a third, less glamorous but absolutely essential pillar: the fortress of patience. This is the art of doing nothing. In a world that prizes action, speed, and constant engagement, the ability to sit quietly, sometimes for years, and wait for the perfect pitch is a superpower. Buffett's contrarian strategy is not about frantic activity, buying at the bottom and selling at the top. It is about long periods of intense preparation and watchful waiting, punctuated by brief moments of decisive action. This patience is what allows him to build up the cash reserves needed to be greedy when fear strikes, and it is what prevents him from getting sucked into the manic activity of a greedy market. Without patience, the entire system collapses. The temptation to do something is one of the most powerful and destructive forces in all of finance. Patience is the shield that defends against it. Our foundational anecdote for the pillar of patience is not a single dramatic transaction, but a long, quiet, and incredibly lucrative relationship. It's the story of Warren Buffett and the Coca-Cola Company. Buffett began buying Coca-Cola stock in 1988. This was right after the Black Monday market crash of October 1987, a moment of significant fear. He saw a phenomenal, globally dominant business with a brand that was virtually unassailable, and the market's temporary panic allowed him to buy it at a reasonable price. Over the course of several months, he invested over $1 billion, acquiring a stake of about 7% of the company, and then he waited. He didn't sell it in 1990 during the Gulf War recession. He didn't sell it in 1994 when there were fears of rising interest rates. He didn't sell it during the dot-com bubble when it was considered a boring, old economy stock. He didn't sell it after the dot-com crash. He didn't sell it before, during, or after the 2008 financial crisis. He just held. Year after year, decade after decade, he simply sat and allowed two powerful forces to work their magic: the business itself and the power of compounding. Coca-Cola continued to expand around the globe, generating billions in profits. A significant portion of those profits was returned to shareholders in the form of dividends. Buffett's initial $1 billion investment started generating tens of millions, then hundreds of millions of dollars in annual dividend checks for Berkshire Hathaway. By 2020, Berkshire was receiving over $650 million in dividends from Coke every single year, a 65% annual return on his original cost basis, just from the dividend. Meanwhile, the value of the stock itself, despite numerous market cycles and periods of volatility, had grown immensely. That initial $1 billion stake is now worth well over $20 billion. This story is the epitome of patience. There were countless times when pundits or analysts suggested he should sell Coke and move into something more exciting. But Buffett understood that finding a truly wonderful business at a fair price is incredibly rare. The real money is not made in the buying or the selling, but in the waiting. His patience also manifests in another way: his willingness to let cash build up on Berkshire's balance sheet. There have been long stretches of time, particularly during the late stages of bull markets, where Buffett made no major acquisitions. In the years leading up to 2008, and again in the years leading up to 2020, Berkshire's cash pile swelled to over $100 billion. He faced criticism for this quote, cash drag, with many arguing he should be doing deals or buying back stock. But Buffett patiently insisted he could not find anything to buy that met his strict criteria of a great business at a sensible price. This enormous cash reserve was not a sign of inactivity. It was the physical embodiment of his patience. It was the loaded gun, the dry powder, waiting for the inevitable moment when Mr. Market would once again be gripped by fear and offer him a deal he couldn't refuse. Patience for Buffett is not passive. It is a strategic position. The psychological enemy of patience is a potent combination of action bias and hyperbolic discounting. Action bias is the innate human tendency to favor action over inaction, even when inaction is the more rational choice. We feel a deep-seated need to do something. In the world of investing, this manifests as a constant urge to tinker with your portfolio. Checking stock prices multiple times a day, buying or selling based on a news headline, constantly searching for the next hot stock. This is action bias at work. It feels productive. It feels like you are in control. In reality, it is often just a way to generate transaction costs and taxes, while disrupting the one force that actually builds wealth: compounding. The investor who constantly churns their portfolio is like a child who keeps pulling a sapling out of the ground to see if the roots are growing. They never give the tree a chance to mature. Hyperbolic discounting is another cognitive flaw that destroys patience. It's our brain's tendency to strongly prefer smaller, more immediate rewards over larger, later rewards. We would rather have $20 today than $100 in a year. This is why people struggle to save for retirement. The immediate pleasure of spending the money now is more powerful than the abstract, distant reward of a secure future. In investing, this bias makes it incredibly difficult to hold a stock for the long term. The small, immediate reward of locking in a 20% gain feels much more compelling than the much larger but uncertain reward of holding for a 1,000% gain over 2 decades. Buffett's mind seems to be wired differently. He has systematically trained himself to override these biases. He combats action bias with a philosophy he calls inactivity bordering on sloth. He loves to buy a business with the intention of holding it forever. This eliminates the constant temptation to act. He has mastered the art of enjoying the process of doing nothing, confident that the great businesses he owns are working for him every day. He defeats hyperbolic discounting by having an exceptionally long time horizon. He is not thinking about the next quarter, he is thinking about the next decade. He is a master of delayed gratification, understanding that the greatest rewards in investing do not go to the most active, but to the most patient. He is not a sprinter, he is a marathon runner who has conditioned his mind to focus on the finish line 26 miles away, not the next 100 yards. So how do we build this fortress of patience in our own financial lives? The applied mental model Buffett offers is the 20-slot punch card. He has said that an investor would improve their results dramatically if, at the beginning of their career, they were handed a punch card with only 20 slots on it. Every time you make an investment, you have to punch a hole. Once you've made 20 punches, you can't make any more investments for the rest of your life. This thought experiment is a powerful forcing function for patience and selectivity. It immediately raises the stakes of every decision. You would no longer make casual bets on speculative stocks. You would treat every allocation of capital with the seriousness it deserves. You would do exhaustive research. You would wait and wait and wait for an opportunity that was so good, so overwhelmingly compelling, that it was worthy of one of your precious 20 slots. This mental model is the antidote to the constant churn and activity that plagues most investors. Here is the blueprint for putting the 20-slot punch card model into practice. Step 1. Adopt the mindset literally. Before any investment, ask yourself, if this were the only investment I could make for the next 3 years, and it had to be one of my 20 lifetime slots, would I still do it? If the answer is anything less than an enthusiastic yes, then you pass. This simple question filters out 99% of the low-conviction ideas that lead to portfolio churn. Step 2. Develop a strict, written set of investment criteria. Don't just have vague ideas about what you're looking for, write them down. For example, I will only invest in businesses with a return on equity above 15%, a debt-to-equity ratio below 0.5, and a consistent history of growing free cash flow. These non-negotiable rules act as a firewall against impulsive decisions and the siren song of a hot market narrative. Your criteria, not your emotions, should make the final decision. Step 3. Build your cash fortress. Reframe how you think about cash. It is not a zero-performing asset that is a drag on your portfolio. It is a strategic position. It is a call option on future market dislocations. Actively build a significant cash position, especially when markets are high and good opportunities are scarce. Your goal is to have enough dry powder to make a meaningful investment, to punch one of your 20 slots when the next crisis arrives. This cash position is the physical manifestation of your patience. Step 4. Learn to disengage. Stop checking your portfolio every day. Delete the stock market app from your phone's home screen. Dedicate a specific, limited time, perhaps once a month or once a quarter, to review your investments. The rest of the time, let your businesses do their work. The less you look, the less you will be tempted to act, and the more power you give to the magic of compounding. The antithesis of this patient approach is the hyperactive trader, the person who embodies the path of the 99%. Let's call this person Kevin. Kevin believes that wealth is built through clever trades and constant activity. He subscribes to multiple financial news services and has a multi-screen setup in his home office to track the market's every wiggle. He wakes up and immediately checks the pre-market futures. His day is a frantic dance of buying and selling. He buys a stock because he hears a positive rumor on a TV show. He sells it 2 days later because an analyst downgrades it. He jumps into a hot biotech stock hoping for a quick pop on their drug trial news. He then sells it to chase a surging solar energy company. Kevin mistakes activity for progress. He feels like a sophisticated Wall Street operator, but in reality, he is his own worst enemy. He is constantly being whipsawed by market noise. His portfolio is a revolving door of positions, never held long enough for any real business value to accrue. What he doesn't fully appreciate is the hidden costs of his activity. Every trade incurs a commission. Every short-term gain is taxed at a high rate. More insidiously, the constant buying and selling ensures that he never benefits from this slow, powerful, tax-efficient magic of long-term compounding. He is paying a massive, hidden, hyperactivity tax that erodes his capital year after year. He is the sapling puller. He is the sprinter in a marathon. His path is one of constant motion, high stress, and ultimately mediocre results. He is a victim of action bias, and he is making his broker rich at his own expense. The direct financial connection between Buffett's patience and Kevin's hyperactivity is one of the most powerful mathematical realities in finance. Let's illustrate with the Coca-Cola example. That $1 billion investment, left largely untouched, grew to over $20 billion. Now imagine if Buffett had been hyperactive. Imagine he sold in 1990 because of the recession, then bought back in 1992, then trimmed in 1995 because it felt overvalued, then sold again in 1999 to chase a dot-com stock, then tried to get back in after the crash. Even if he had been a brilliant trader, the combination of transaction costs and, most importantly, taxes would have been a catastrophic drag on his returns. Every time he sold for a gain, he would have had to pay a large portion of that gain to the government, leaving him with less capital to reinvest for the next leg up. This tax friction is a killer of long-term returns. By simply holding, he allowed the entire untaxed sum to continue compounding for him year after year. The financial advantage of patience is not just qualitative, it is a quantifiable mathematical certainty. The formula for compound interest has time as its most powerful exponent. The person who allows that exponent to grow uninterrupted will achieve results that are orders of magnitude greater than the person who constantly resets the clock by trading in and out. Furthermore, Buffett's patience in holding cash has an equally direct financial impact. That $100 billion in cash might only earn 1 or 2% in interest. But when a crisis like 2008 hits and he can deploy that cash to earn a guaranteed 10% dividend plus warrants, the effective return on that patience becomes astronomical. The cash wasn't a drag, it was a coiled spring, and the financial crisis was the trigger that released its immense potential energy. Patience, therefore, is not a passive virtue. It is an active financial strategy that minimizes friction and maximizes opportunity. We have established the core strategy: buy fear, sell greed, and the essential ingredient that makes it possible: patience. But there is a fourth pillar that acts as a crucial targeting system. You cannot simply buy anything that has gone down, nor can you sell anything that has gone up. The entire framework rests upon a deep and humble understanding of what you are buying and selling. This is Buffett's famous concept of the circle of competence. It is the principle that you don't have to be an expert on every company. or even many. You only have to know your own limits and stay strictly within them. The contrarian approach is only profitable when it is applied to assets whose intrinsic value you can confidently determine. Buying into a collapsing stock in an industry you don't understand is not contrarian investing, it's just gambling. The circle of competence is the safety ring that separates the professional value investor from the amateur speculator. The foundational anecdote that illustrates the power of the circle of competence and a moment that marked a significant evolution in Buffett's own thinking was the acquisition of See's Candies in 1972. Before this, Buffett was a pure disciple of his mentor, Ben Graham. He looked for cigar butt companies, businesses that were statistically cheap, often mediocre, but had one last puff of value left in them. See's Candies was different. It wasn't a cigar butt. It was a wonderful business, but its asking price of $25 million was 3 times its book value, a price that would have made the younger, Graham-trained Buffett walk away instantly. It was his partner, Charlie Munger, who pushed him to evolve. Munger argued that it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett and Munger understood the candy business. It was simple. They saw that See's had a powerful, durable, competitive advantage, a moat, as Buffett would later call it. This moat was its brand. For decades, See's had built a fanatical customer loyalty on the West Coast, particularly in California. People associated the See's name with quality, nostalgia, and special occasions. This powerful brand gave the company pricing power. They could raise the price of their box chocolates every year to account for inflation, and their customers would happily pay it without shopping around for a cheaper alternative. The business itself was also magnificent. It required very little new capital to grow. It generated a gusher of cash every year, particularly around Christmas and Valentine's Day. Buffett and Munger could understand this business model inside and out. They could reasonably predict what its cash flow would look like 5, 10, and 20 years into the future. It was squarely within their circle of competence. They paid the $25 million. That decision was a watershed moment. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent back to Omaha to be reinvested in other opportunities. It required almost no additional capital investment. It was the gift that kept on giving. The lesson was profound. The real secret was not just buying cheap assets. It was buying wonderful businesses you could understand, and then letting their inherent quality do the heavy lifting for you over time. His willingness to buy Coca-Cola in 1988, another simple, understandable business with a dominant brand, was a direct descendant of the lesson he learned from See's Candies. Conversely, his refusal to buy the dot-com stocks in 1999 was the other side of the same coin. He openly admitted he didn't understand their business models or how to project their future cash flows. They were outside his circle, so he simply said, "Pass." The underlying psychological principle that makes the circle of competence so vital is its role as an antidote to the Dunning-Kruger effect. This is a cognitive bias wherein people with low ability or knowledge in a particular domain tend to overestimate their ability and knowledge. In simpler terms, it's the phenomenon of being too ignorant to recognize your own ignorance. In the world of investing, this is a catastrophic flaw. The amateur investor who reads one article about gene editing suddenly believes they are qualified to pick the winning biotech stock. The person who has a good experience with a new app feels they have a deep insight into the software industry. The Dunning-Kruger effect creates a dangerous illusion of competence, leading people to make large bets in areas where they have, at best, a superficial understanding. They don't know what they don't know. When a crisis hits the industry they've invested in, they have no foundation of real knowledge to fall back on. They can't tell if the price drop is a temporary panic or a signal that the company's fundamentals have permanently soured. Lacking true conviction, their only recourse is to panic and sell along with the herd. Warren Buffett's approach is the polar opposite. He is relentlessly focused on avoiding the Dunning-Kruger effect. He is famous for saying that the most important thing is to, quote, know the perimeter of your circle of competence. He doesn't spend his time trying to become an expert in everything. He spends his time making absolutely sure he doesn't stray outside the boundaries of what he already knows intimately. This intellectual humility is his greatest defense against making a catastrophic error. He knows that the biggest investment risks don't come from the things you know, but from the things you think you know but don't. By staying within his circle, he ensures that when he does decide to be greedy in a fearful market, he is acting from a position of deep knowledge and conviction, not from a place of speculative hope. How do you as an investor or a business leader apply this principle? The mental model is defining your perimeter. This is not an exercise in ego or trying to expand your circle. It is an honest and sometimes humbling exercise in self-assessment to clearly define where the edge of your knowledge lies. Here is the blueprint for defining your perimeter. Step 1. The two-sheet test. Take out 2 blank sheets of paper. On the first sheet, titled My Circle, write down the industries, businesses, and technologies that you understand at an expert level. This doesn't mean you've read an article about them. It means you could give a 1-hour lecture on the competitive dynamics of the industry, how the leading companies make money, what their key risks are, and what drives their profitability, without any notes. Be brutally honest with yourself. For most people, this list will be very short. Step 2. On the second sheet, titled Too Hard Pile, write down everything else. This will be a very long list. It will include things like biotechnology, complex software, cryptocurrency, international shipping, and thousands of other industries. This is your pass pile. Step 3. Make a sacred vow. Vow to yourself that you will only ever invest your serious, long-term capital in companies that come from the first sheet. You will treat the second sheet as a source of entertainment or intellectual curiosity, but never as a source of investment ideas. This act of self-limitation is an act of financial self-preservation. Step 4. The 10-year-old test. For any potential investment, even one from your My Circle sheet, apply this final filter. You must be able to explain, in simple terms that a 10-year-old could understand, exactly why this is a wonderful business and why you are buying it. If you find yourself using jargon, complex financial terms, or vague platitudes, you probably don't understand it as well as you think you do. The ability to simplify is a hallmark of true understanding. If it fails this test, it goes into the too hard pile. This rigorous process ensures that you are always operating from a position of strength, investing in what you know, and avoiding the siren song of industries that are exciting, but ultimately beyond your true comprehension. The antithesis to this disciplined approach is the narrative chaser, and this is the path of the 99%. The narrative chaser doesn't invest in businesses, they invest in stories. Their portfolio is a reflection of whatever exciting theme is currently dominating the financial media. In 1999, they bought the Internet Revolution narrative. In 2006, they bought the housing prices never fall narrative. From 2015 to 2020, they bought the disruptive innovation narrative, often buying baskets of unprofitable tech companies simply because they were part of a popular thematic ETF. More recently, they might have chased the artificial intelligence or cryptocurrency narrative. The narrative chaser doesn't have a circle of competence because they don't believe they need one. They are outsourcing their thinking to the storytellers, the market gurus, the TV pundits, the social media influencers. They buy because the story is compelling and the price is going up. The problem is that they have no anchor when the story changes. Because they never truly understood the underlying business, they have no way of judging its intrinsic value. When the stock falls 30%, they have no tools to determine if it's a buying opportunity or the beginning of the end. Their conviction is only as deep as the latest headline. Lacking any fundamental grounding, they inevitably do what all narrative chasers do. They buy high, when the story is at its most exciting and widely believed, and they sell low, when the narrative sours and fear takes over. They are constantly whipsawed by the market's changing moods, always one step behind, because their entire investment philosophy is based on following the crowd, not on independent thought. The direct financial connection of the circle of competence is found on the financial statements of the companies Buffett buys. A business with a strong, durable moat, the kind of business you can understand, has quantifiable characteristics. It has consistently high gross margins, which demonstrates its pricing power. Think of See's Candies or Coca-Cola. It has a high and stable return on invested capital, which shows that it can reinvest its profits efficiently without requiring huge new injections of cash. It generates predictable and growing free cash flow, the lifeblood of any business. When you operate within your circle of competence, you are able to read a company's financial statements, not as a collection of numbers, but as a story about its underlying business reality. You can connect the brand loyalty you see in the real world to the high margins you see on the income statement. This ability to reasonably forecast future cash flows is the absolute foundation of value investing. It's what allows you to calculate an intrinsic value for the business. Without that calculation, you are flying blind. You have no way of knowing if a price is high or low. The financial advantage, therefore, is profound. It is the difference between investing, which is the act of buying a future stream of cash flows at a discount, and speculating, which is the act of betting on which direction a price ticker will move next. The former is a proven path to wealth building. The latter is a proven path to the poorhouse. We have now assembled 4 powerful pillars: the strategy to be a contrarian, the patience to execute it, and the knowledge to aim it correctly. But all of this is for naught without the final and perhaps most crucial pillar, the emotional detachment protocol. This is the mental operating system that runs in the background, allowing you to deploy the other 4 pillars under extreme pressure. You can know intellectually that you should be greedy when others are fearful, but when your own portfolio is down 40% and the world seems to be ending, it is emotion, not intellect, that takes the driver's seat. Mastering your emotions is the final boss in the game of investing. It is the invisible infrastructure that supports the entire Buffett methodology. It's about building a psychological fortress that can withstand the emotional siege of a market in turmoil, allowing you to make rational decisions when everyone else is losing their minds. Our foundational anecdote for this pillar takes us back to the early days of Buffett's career, to a bizarre and fascinating episode known as the Salad Oil Scandal of 1963. The story centers on a company called American Express. At the time, Amex was primarily known for its travelers' checks and charge cards, but it also had a lesser-known warehousing division. One of its biggest customers was the Allied Crude Vegetable Oil Company, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had borrowed hundreds of millions of dollars from Wall Street banks, using his vast inventory of salad oil stored in Amex's warehouses as collateral. The problem was, the salad oil didn't exist. The giant storage tanks were mostly filled with water, with a few feet of oil floating on top. When the fraud was discovered, Allied Crude collapsed, and the banks who had loaned the money came after American Express, holding it responsible for the fraudulent warehouse receipts. The market panicked. Wall Street assumed the liabilities would be catastrophic, potentially bankrupting American Express. The stock, a blue-chip darling, collapsed, falling by over 50% in a matter of weeks. This was a moment of intense, concentrated fear, focused on a single company. The herd was selling indiscriminately. But Warren Buffett, then a young, relatively unknown fund manager, did not panic. He applied a protocol of emotional detachment and fact-based inquiry. Instead of listening to the terrified whispers on Wall Street, he went out to do his own primary research. He went to restaurants in Omaha. He talked to bank tellers. He visited travel agencies. He was looking for the answer to one simple question. Was this scandal affecting the underlying business of American Express? He observed that people were not throwing away their Amex cards. Merchants were still proudly displaying the American Express accepted here signs. Travelers were still buying the travelers' checks. The fear was entirely concentrated on the Wall Street scandal, but the company's powerful consumer moat was completely intact. The fundamental business was unharmed. He concluded that the market's fear was a massive overreaction. He separated the emotional narrative from the business reality. Convinced of his analysis, Buffett made an audacious move. He invested 40% of his entire investment partnership, a massive, career-defining bet, into American Express stock. As the company eventually settled the legal claims for a fraction of what the market had feared and its core business continued to thrive, the stock roared back. The investment was a grand slam, multiplying his partner's money and helping to cement his reputation as a brilliant contrarian investor. This was the emotional detachment protocol in its purest form. Ignore the panic, do the work, verify the facts, and when the facts are in your favor, act with decisive conviction. The psychological biases that Buffett overcame in the salad oil scandal are some of an investor's most dangerous foes: the affect heuristic and confirmation bias. The affect heuristic is our tendency to let our emotions, our gut feelings, drive our decisions. When we hear bad news about a company, it generates a negative feeling or affect. We then use that feeling as a shortcut to make a judgment. The story of the salad oil fraud felt bad. It smelled of scandal and ruin. Therefore, the gut reaction was that American Express was a bad stock, and the correct action was to sell. This is fast, intuitive, and often disastrously wrong thinking. It substitutes emotional reaction for rigorous analysis. Confirmation bias is the natural human tendency to search for, interpret, favor, and recall information that confirms our pre-existing beliefs. Once an investor decided, based on the affect heuristic, that Amex was doomed, they would then subconsciously seek out evidence to support that conclusion. They would pay close attention to the bearish analyst reports, the negative newspaper headlines, and the rumors of massive lawsuits. They would ignore or downplay any evidence to the contrary, such as the continued strength of the company's consumer brand. These two biases create a powerful feedback loop of negative emotion and reinforcing information, leading to the kind of panic that creates huge opportunities for a detached, rational mind. Buffett's method is a systematic assault on these biases. His process of going out and doing his own legwork was a direct countermeasure to the affect heuristic. He was replacing the market's bad feeling with his own cold, hard data. He actively seeks out disconfirming evidence, constantly questioning his own assumptions, which is the only way to break the grip of confirmation bias. He understands that in the midst of a panic, your gut is the most dangerous advisor you have. True investment mastery comes from silencing that gut instinct and relying instead on a disciplined, evidence-based process. So how do we build this protocol for ourselves? The applied mental model is a two-part system: the investment journal and the devil's advocate. This system is designed to externalize your thinking and force a structured, logical approach, even when your mind is clouded by fear or greed. Part 1. The Investment Journal. This is a physical or digital journal where you codify your thinking before you make any investment decision. Before you buy a single share, you must write down the following. 1. The thesis. In a few clear paragraphs, explain exactly why you are buying this asset. What is the business? What is its moat? What is the catalyst for its value to be realized? 2. The valuation. Detail your calculation of the company's intrinsic value. Show your work. What are your assumptions about future growth and profitability? At what price would the stock be a bargain? At what price would it be fairly valued? At what price would it be expensive? 3. The pre-mortem. Write down the primary risks. What could go wrong with this investment? What would cause you to change your mind and sell? Be specific. I will sell if the company loses its largest customer, or I will sell if their debt-to-equity ratio exceeds 1.0. This simple act of writing does something profound. It transfers the logic from the emotional, fast-thinking part of your brain to the rational, slow-thinking part. It creates a record of your thinking in a moment of calm that you can refer back to in a moment of panic. When the stock drops 30% and fear sets in, you don't have to rely on your frazzled memory. You can pull out your journal and review your original, rational thesis. If the reasons you wrote down for selling have not occurred, then the price drop is not a threat. It is an opportunity to buy more, just as your valuation work suggested. Part 2. The Devil's Advocate. This is the active process of combating confirmation bias. Once you have your thesis, your job is to try and destroy it. You must actively seek out the smartest, most articulate arguments against your investment. Read the bearish analyst reports. Go to online forums and find the most intelligent person who thinks you're wrong and try to understand their position. Your goal is to argue against yourself with more passion and intelligence than anyone else could. Charlie Munger calls this inverting the problem. Instead of just asking, "Why will this work?" you must constantly ask, "Why will this fail?" If, after making the strongest possible case against your own idea, your original thesis still stands strong, then and only then do you have the right to invest. This two-part system, journaling to codify your logic and playing devil's advocate to stress test it, is a powerful protocol for building the emotional detachment necessary to execute a contrarian investment strategy. The antithesis of this disciplined protocol is the emotional roller coaster, the default state for the 99% of investors. This person's state of mind is directly tethered to the daily fluctuations of the stock market. On a green day, they feel brilliant, euphoric, and validated. They check their portfolio constantly, savoring the gains. On a red day, they feel anxious, foolish, and filled with dread. The market's movements dictate their mood. Their investment decisions are not based on a pre-written journal or a devil's advocate analysis. They are pure, unfiltered reactions to the dominant emotion of the moment. They buy a stock because of a surge of FOMO after seeing it mentioned everywhere. They sell a stock because of a wave of panic after seeing a scary headline. Their portfolio is not a collection of carefully chosen businesses. It is a chaotic mess of emotional reactions. There is no system, no process, only a series of impulsive moves driven by the twin demons of fear and greed. This person is guaranteed to underperform over the long run, not because they are unintelligent, but because they have allowed their emotional brain to be in charge of a game that requires a cold, logical mind. They are a passenger on the market's emotional waves, tossed about helplessly, rather than a surfer who has learned to ride those waves to their advantage. The direct financial connection of emotional detachment is the prevention of unforced errors, which are the primary destroyer of investment returns. Every time an investor panic sells at the bottom or FOMO buys at the top, they are making an unforced error. These errors have a direct and devastating mathematical impact on a portfolio. Selling at the bottom not only locks in losses, but also causes the investor to miss the subsequent, often rapid, recovery. Buying at the top increases risk and dramatically lowers the potential for future returns. A systematic, non-emotional approach, like the protocol we've described, creates a vastly superior long-term result. Consider two investors, each starting with $100,000. One follows the emotional roller coaster, selling during crashes and buying back in after the market feels safe again. The other follows a detached, systematic approach, perhaps simply rebalancing their portfolio once a year, selling a little of what has done well and buying a little of what has done poorly. Over a 30-year period, the systematic, detached investor's portfolio will be orders of magnitude larger. The financial advantage is not generated by brilliant stock picking, but by the simple, steady avoidance of emotion-driven mistakes. Emotional detachment is the ultimate defense. It preserves your capital from your own worst instincts, allowing your well-laid plans to come to fruition without being sabotaged by your primal brain. It is the final, essential piece of the puzzle, the governor on the engine that ensures the entire system of contrarian value investing runs smoothly and profitably over a lifetime. You have just been given a powerful weapon. The principle of being greedy when others are fearful, and fearful when others are greedy is not just a market aphorism. It is a complete psychological operating system for decision-making under pressure. You now understand the anatomy of fear and the mechanics of greed. You have the blueprint for building a fortress of patience, for defining your circle of competence, and for installing the emotional detachment protocol that makes it all work. This is more than just an investment strategy. It is a tool for achieving a rare and powerful form of independent thinking. You have acquired a new lens through which to view the world, one that allows you to see opportunity where others see only chaos, and risk where others see only euphoria. But mastering this one powerful principle is only the first step. Warren Buffett's system is not a single pillar, it is a grand cathedral of interconnected mental models. The contrarian principle you've just learned is the foundation, but there are other, equally powerful concepts that form the arches, the buttresses, and the spires of his thinking. What you have learned today is a crucial piece of the map, but it is not the entire map. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of it as the missing link, the piece that connects the principle of market psychology you've just mastered to the next level of Buffett's system. Perhaps the deep science of identifying competitive moats, or the intricate art of capital allocation. To stop now would be like learning how to forge a sword but never learning how to wield it. The knowledge you have is powerful but incomplete. The choice to click is not about watching another video. It is a choice about who you want to become. Are you a passive consumer of information? Or are you an active builder of a complete mental arsenal? The 99% will drift away now, satisfied with a surface-level understanding. But for those who are serious about their ascent, for those who are committed to achieving true financial and intellectual sovereignty, the path forward is clear. Complete your arsenal. Click on the next video and secure the next piece of the map.